before I start the discussion, I want to emphasize a few matters. Especially, we focus when preparing this paper the areas that student not scored very well in the past exam. As per the guidance I received also from CS Sri Lanka, I realized that project appraisal, interest rate, risk management, financial market activities, that general knowledge of the financial management is the lacking areas of the CFRM syllabus, right? Based on that, I have prepared this paper, and I got a lot of news that paper is uh, very tough and difficult to answer. That's why actually I also wanted, because what I realized, the students only focus on few selected questions, valuations, working capital management, and few areas they are focusing and trying to get to the subject. That is the biggest drawback that is student facing in answering the exam paper, real exam paper. Okay, let's start the discussion. I will share my screen. Once you can see the screen, please text me whether you can see it or not. Okay. Let's start with the question number 1, right? Before read the entire paragraphs given in these unseen small questions, I advise you to go through the question first and understand what examiner asks, right? Given condition in the global debt market as described above, advice on likely factors bank will consider, right? This is the most important part. Bank will consider in offering a loan of this size. The bank is the lender. What are the factors that lender consider, the banks consider when offering a loan relating to the amount given in the case? Then you have to understand what are the factors generally banks consider when offering a loan to a customer, right? The other thing, you need to relate this with the given condition in the global debt market, right? Then what is the debt market? That's the most important part, right? What is the debt market? Debt market consists the bank borrowings and loan notes, debenture issue market, the related instrument market. Now, for an example, when an entity wanted funds, they can borrow from the market, or they can issue their securities, that loan notes or debentures at the market and collect money, like debenture or loan notes, right? Altogether, we call debt market. The person who have excess money will lend money to the corporates, right? When they lend money to the corporate, the sources are through banks. People lending money to the corporate, so the investor can buy bonds or loan not issued by the entity, right? Given condition in the global debt market, right? Advise how banks consider, what are the factors that are banks consider when offering a loan. That's the question, right? I think you have understood the question. Not now, at the time you answered the paper. Just tell me, did you have any different understanding? If you can text me, it's better, right? I think while you answering the question, you realize the real meaning of the question. Nobody texts me, right? Okay. Those who have faced the exam, if possible, please text me and tell me whether you really understood the question what I have explained now. Right? Okay. Now let's read the information given. You are the chief financial officer of Moose Company. Moose is a manufacturer of cleaning equipment and has an international market for its product. Your company places a strong emphasis on innovation and design with patent protection across all its product range. Now, this information says, now you have to think this from the perspective of the bank. Now, this company is the customer, right? Now, you are the CFO of this company. From your side, you have a strong product range. That means in future cash flows generation is more than 100% sure because you have strong product range with protection, right? Therefore, you can earn money easily in future in order to service the loan. Now, you are the CFO of this company, but question asks, what are the factors that bank consider when lending to you? Right? That's the question. Now, one thing you are strong, your strength is you have a good product line which gives you continuous cash flows to the business. The company has two principal manufacturing centers, Europe, which has been reduced in size in recent years because of high labor cost, and the Southeast Asia. However, most company development has relied upon ready access to the debt market both in Europe and Southeast Asia. And the company is planning significant expansion with new manufacturing and distribution center in South America. Now, this is the plan. They are trying to move to South America, right? The company is highly profitable. Those are the strength you have with the strong cash flows. Although it is last 2 quarters, there has been downturn in sales in all market as the global recessions has begun in takeoff. In comparing the global economic conditions, you have a good position in the market with cash flows, profit, and everywhere. Since 2000, let's say 27, credit condition have deteriorated across all of the major economies as bank have curtailed their lending following the downgrading of US asset-backed securities. In 2028, let's take in the last decade, that 2018-19, many banks recorded significant multi-billion dollar losses as they attempted to sell off what had become known as toxic debt, leading to a further collapse in their value. In response, many banks also attempt to repair their balance sheet by right and other equity issues. Now, in the market, banks are in a trouble, right? They are in a trouble. That means they lost many receivable balances because of the economic recession, right? And their balance sheets become weakened. Then they wanted to strengthen their balance sheet. Therefore, they are trying to issue right shares, and they are trying to issue shares and collect money to strengthen their balance sheet. The founder and executive chairman, sorry, the founder and executive chairman of the company, Alan Bison, is planning to round off meeting with a number of investment banks in leading financial centers around the world to explore raising a $350 million loan for the new development. It has been it has already been suggested that a loan of this size would need to be syndicated or alternatively raised through a bond issue. There are two words. Two students talked to me after the exam. Then they didn't know that I am the person who prepared the paper, but they asked, sir, there were two wordings in the paper. We didn't hear that. But if you go through properly in the study text, they have clearly explained what is syndicated loan, what is bond issue. The syndicated loan, generally what happened in the market, uh, say you wanted to have a big amount of money to start a big project that single bank cannot lend you. Then what the banks do, banks will talk to other banks and create a group of banks to facilitate this loan. That means you are not going to borrow from A to Z all the banks. Single bank will be the leader, and they will negotiate with other banks and collect money from other banks and lend to you, right? Single bank will be the interface for you. They will give you the money, but the bank collect money from other banks as well, since that amount is huge. That's called syndicated loan. So you want 1,000, so $500 million for a project. Your bank is A. That individually that bank can't lend that amount. Therefore, they will talk to another 5 6 banks and collect money and give you the 500 million. Your bank will be the leading bank. They will in front of you. They will negotiate with you, but the banker will talk to other bank and collect money and lend you. Then in reality, you have a lot of lenders, not in a single bank, but single bank act as the leader. That's called syndicated loan. Now, because of this amount of is huge, they suggested that go for a syndicated loan, as we discussed now, or a bond issue. The chairman has also heard, sorry, the chairman has also heard about Islamic finance providing an alternative to conventional forms of finance and is keen to find out more about the benefit and drawbacks of using Islamic finance. In preparation for those meetings, he has asked you to provide him with some briefing notes. Now, chairman wanted to meeting with the people within the organization. You are the CFO of this organization. Now, chairman wanted the information asked in the question. That is, chairman asked you, based on the current debt market condition, generally what are the factors that banks consider offering this type of loan? It's a huge amount of loan. That's the question, right? Now, we have to think about the bank's perspective because now there is an economic recession in the market. A lot of banks gone to nearly bankruptcy. They are losing a lot of receivable balances because of the bankruptcy of the companies. Therefore, banks running lack of funds. Therefore, they wanted to issue shares and issue right issues and make additional capital infusion to the banks. This is the current issue in the market. Meantime, your company go on and ask $350 million loan from the bank. In such a situation, what are the factors that bank consider? That's a question, right? Moving into the answers. I'm not going to read one by one. We will share this answer with you. Here, just read the other things once we share, right? Numerous banks come to close to bankruptcy, many of which had to be bailed out by their respective government. As a result, there has been greater reluctance to bank to lend money. That is the situation when there is an economic recession, right? A lot of banks reluctant to lend money in this situation. Banks with no government bailout package were forced to raise additional equity capital low in order to maintain their capital adequacy ratio, which means that liquidity was significantly reduced. When banks trying to issue right shares and new shares to raise additional capital, that means they won't motivate to lend huge amount of money to customers because they are running with liquidity issues. More stringent requirements were put in place for potential borrowers, both corporate and individual. That effect have been widely felt. In such a situation, when a company or individual go and ask money, huge amount of money from a bank will give list of requirements to fulfill before lending, because the finance risk not only with that lender, within the entire economy. A lot of companies go on bankruptcy, people can't repay their debts, right? In such a situation, how a single company lend 350 million to you? Therefore, they will ask lot of documents from you. That is the reality. Lot of requirement to fulfill. Meantime, mainly bank will consider the lending rate, right? The lending rate is an important factor they have to consider. Generally, when people lending money, lender takes risk-free rate and make a risk assessment of the specific lender and grade them. Then they will include risk spread on the risk-free rate and create the lending rate. I think you already aware of those things, right? Risk-free rate plus risk spread. The risk spread is a calculation based on the risk of the borrower, right? That risk spread will be decided based on risk rating. Agencies already generally they publish risk rating of each specific companies. Based on that, that blender can take what is the risk spread you need to add on the risk free rate, or bank itself they can make an assessment on the borrower and identified how much the risk spread I have to include on the risk free rate. Those depend, right? Therefore you have to explain those things. In addition to that, when the economy is going recession, most of companies going bankruptcy, you need to consider that country risk, economic risk as well, right? Then default risk. There remains a concern, but as most companies relatively strong liquidity position, it may be looked more favorably by the bank. You can explain. Default risk is high at the market because a lot of companies not paying their installments to bank. Banks running out of liquidity. Bank running out of collections. But your company have a strong position. You are making profits. You have enough cash. You have future cash flow projections, right? Future cash flow projections. Therefore, a bank will consider default risk, but that won't affect you comparing to the other borrowers, right? As well as cash flow strength, when you ask a loan from a bank, they definitely ask you to provide a cash flow forecast, right? Therefore, cash flow strength you have to prove them, right? Bank will ask, what is the cash flow strength you have, right? Then next point, what is the collateral you are going to present, right? Generally, these things you can keep in your mind: liquidity risk, default risk, lending rate, cash flow projection, and the collateral, right? What is the security you are going to produce to the bank when you're going to borrow money for a project? What is the security you will give them? You are going to invest in USA. You may have land, building, machineries, right? Some assets there. Bank will ask to provide some securities against the facility. Therefore, as factor-wise, lending rate, default risk, cash flow forecast, then security or what is the collateral, those are the things basically banks ask. But when you explain this, you have to connect to the current situation, right? Like we discussed default risk. You can explain default risk is not highly affect this our company because our company have strong cash flows. We have continuous learning profits. We have a strong product range. Continuously, it will generate future cash flows to us, right? Likewise, you have to explain the lending rate. Lending rate generally sets based on the risk-free rate plus risk spread, especially assessed on the borrower, right? But now a situation, economy going down, there is economic recession. Therefore, in addition to the risk spread on the company, they will consider risk in the country, risk in the economy when they set the rate, right? Then cash flow forecast and the collateral, those are the basic things. I don't know why you have felt that this is very difficult paper, but these are general questions, right? That's how you have to answer for the first part of first question. Part A somewhat understood, but part B of the question was nothing. Okay, now tell me part A, have you understood the answer, what I have explained? Then I can move to the B. Right. Now, one of the students said that part B not understood. Part B means part B of this question or the second part? Tell me. Now, when you say part B is, I think, this question, right? Am I correct? You are referring part B as this question, right? Assess the relative advantage of loan syndication versus bond issue. Is that the question? The student who told me not understood was nothing. Okay, right. Now, this is your study task, right? If you take this carefully, you have table of content. What are the topics? I don't know how you have studies. You may have self studies. You may have participated some classes online, physical. I don't know, but this is the thing you have to learn, right? Here, you have to start the discussion of financial management subject from here. First, you have to learn topic 1, then you have to learn topic 2, then you have to move into topic 9, not topic 9, topic 11, then topic 12. After topic 1 and 2, you have to move to topic 11 and 12. Why I'm saying that? This explain the financing sources and different finance sources available. They will give here, it gives you a proper understanding. Now if you take topic 11, debt financing, right? Debt financing, sorry. Okay, this is the topic, debt financing. Look at the learning outcome the examiner expects. Discuss the different types of long-term financing of a firm. Analyze the impact of different debt financing alternatives, right? Loan, bonds, debenture, leasing. Now, loans is the one we talk. Syndicated loan is a one type of loan. Now, this is the examiner, what examiner expect from you. You must understand this and learn, right? Now, then in the chapter, you can see one by one, it explain, right? What are the what the banks consider when lending. Everything, once you read this, you can easily understand, right? Syndicated loan is a word used in the market. If you want to be a chartered accountant and become a CFO, you must know that word. That's why I wanted to include this question and give you that examiner expect basically the basic market knowledge from you, right? Therefore, now you don't, I think you don't have enough time to read this, but my advice, at least read chapter 1 to 11 and 12 before the exam, right? That's more important. Okay, let's move into the second part. Assess the relative advantage of loan syndication versus bond issue to Moose company. Now you have to consider from the perspective of Moose company. Right here, there is a mistake. I will make it before distribute the answer among you, because I have taken that topic here, the page setup issue. This is the question. Right, we are going to answer this question. Right. Here, loan syndication is the combination of several lenders. Very simple, right? Loan syndication is a combination of several lenders to provide various proportion of loan. One lender normally leads the syndicate. One of the benefit of syndication is that it allows banks to offer much higher loans that would normally be feasible if acting singly. As several banks provide a smaller portion of the total principal, whilst the effective cost of syndicate loan is like to be higher than the obtained from a single lender. Because the bank to bank, they have different risk rating on you, therefore they will charge different rates. Once you take it and average it, your rate may be generally higher than the rate you can take directly from a single bank. That's a disadvantage. But advantage is you can borrow more than the amount you can borrow from a single bank, right? If you take bonds are where the borrowing is securitized and plotted on the capital market. You can have listed bonds or unlisted bonds, right? With a coupon rate and set redemption date. You know about the bonds, right? I'm not going to talk those about the bonds, right? One of the disadvantages of bonds is the high issue cost. Generally, when you issue bonds, you have to have a promoter, you have to pay issue cost, right? As with bank loans, some bonds may be syndicated with an investment bank managing the process. The size of the loan being sought it at the lower end of the scale of loan that might be raised through bond issue. There is evidence to suggest that large companies with high credibility and performance prefer syndicated loan. Companies with higher levels of short-term debt and are perceived by the bank to have more growth opportunities tend to favor of bond issue, right? Just read it and I understand. My advice again is read chapter 1 to 11 and 12 before the exam. That is very important, right? Okay. Now that is a part A of the paper. Now we are moving part B of the paper, right? Let's see any question whether you have. Yeah, I'm sharing the answer sheet, so don't worry, right? Okay, now part B. They said that they couldn't understand this part B, this one. Okay, again, let's see what examiner asked, right? That's the important part. My advice, read the question first, then read the paragraphs later. Calculate the expected return of the investments in each of the three tranches described above. Estimate the sensitivity of the subordinated certificates to a reduction of 1% in the returns generated by the pool. Why you can't understand this, I will tell you. This is a general business idea you must learn, right? Let's read the question one by one. I will explain. The finance division now Goslow Motor Corporation has made a number of loans to customers with a current pool value of 200 million. That means you have receivable balances from customers. Is that clear? You have 200 million receivable balance from customers. While you selling the item products, that motor vehicles or some item, you are giving them on lease basis or higher purchase basis or on loan basis. Then there is a 200 million receivable balance from the customers, right? The loan have an average term to maturity for 4 years. The loans generally steady income to the business of 10.5% per annum. Now, there is a, as per SLFRS 15, right? As per SLFRS 15, when you sold goods on credit terms, you will recognize the debtor, right? Contract receivable, and you will charge interest on that balance. That is IFRS 15's requirement for sales on credit, right? Is that clear? Tell me whether that's clear. Okay. Now you have a loan balance receivable from customers which you have recognized at the time of revenue recognition. Thereafter, annually you will charge interest on that, right? That rate is 10.5. That means on 200 million, 10.5% is the interest income you charge on the receivable balance. Just note down somewhere, right? You are charging annually 10.5% on 200 million as interest income to the P&L. The company will use 95% of the loan pool as collateral for collateralize the loan obligation is structured as follows. What's the meaning of that? I will show you. Now, say this is your balance sheet, right? Simple. I will take traditional model, simple balance sheet, right? This is your balance sheet. Now this is the asset side. This is the asset side as per the balance sheet format, traditional format. This is equity plus liability, right? Here you have contract receivables. Simply it's called loans to customers, right? Loan means the general wording among the people who works in the business. Accountants calls it contract receivables. Loans to customers, right? You have $200 million loan given to customers. It gives you, right? It gives you 10.5% per annum as interest income. If you take this as your P&L, right? Annual P&L, let's quickly take that one also. This is the annual P&L. Annual, it gives you 10.5%. I think you got the point, right? Then you have interest income of 10.5% on this. Right? Now let's go to the question again. Now what they have did, the company they have not yet used, will use these debtors to pledge against the loan they are going to take, right? That means when company wanted to borrow money, it's come under non-current liability or current liability, whatever, right? You want to take a loan. You want to take a loan. Once you taken the loan comes here, right? Loan comes here. But banks won't lend you money without giving security to the bank. You want to give them a security, right? The security here that company going to use is this debtor balance. They are going to give this loan receivable from customers as a security to the bank. They are going to do that to take this loan. That's the point you need to understand. Tell me whether you got that point. Right. Now, question says the company will use 95% of the loans pool as a collateral for the collateralized loan obligation is structured as follows. That means company is going to pledge 95% of debtors 80% of the collateral value to support a tranche of A-rated floating rate loan notes offering investor LIBOR plus. Now there is a different wording, right? Don't think about that. If it is in Sri Lanka, it will become AWPLR. Don't worry about this LIBOR thing, right? Investors LIBOR plus 1.4%. That means company is going to borrow. They will give collateral equal to 95% of this debt. That is 190, right? Out of that, right, 80%, right? Out of that, 80% of the loan, out of that, equal 80% on this, right, will be A-rated floating rate loans. Rate will be LIBOR plus 1.4%. This is number one, right? And then that is out of 295 will be the collateral. That means that is the amount they are going to borrow. Out of that, 80% will be the A-rated, right? 80% will be the A-rated floating rate bonds. Let's say bonds. Then easily you can understand. A-rated bonds. Now, this rate is your finance cost, right? This rate. This is your finance cost. Number two, 10% of the collateral value to support the tranche of B-rated fixed rate loan notes. That is 11%. There's another loan you are going to borrow. That is 10% of this, right? That is B-rated fixed rate loan, fixed rate bonds. Loan note means bonds, right? That rate will be 11%. That's your finance cost. There's another one, 10% of collateral value to support, because total should be 100%, right? Balance 10% of the collateral value to support the tranche as subordinated certificate unrated, right? Balance 10%. It's subordinated certificate unrated. Let's say bonds. Unrated. Unrated means subordinated bonds or certificate, whatever loan notes. Unrated means you are not going to give the priority for this loan. When there is a bankruptcy or dissolvement of the company, you will give priority to repay the debts before the capital. Again, out of the debt, you will give priority for A-rated bonds, then B-rated bonds. Finally, it's come to the subordinate bonds. That means you are not give priority for the settlement. First, you give the priority for securitized, collateralized, A-rated, B-rated bonds. A-rated gets the first option, then it goes to B. Finally, it comes to subordinated. The other thing is, these type of subordinated bonds unrated, that means you have not given specific securities. Just you mentioned, this is the amount, right? They have not mentioned the rate for that. Clear? In order to minimize the interest rate risk. Now again, we are talking about the company. In order to minimize the interest rate risk, the company has decided to enter into a fixed for variable rate swap. Now, I know what is the question you have. When you heard the word in swaps, you have a format in your mind. You are trying to do interest rate swaps. But here you can't do interest rate swaps. It's a single strategy within this question that company use. They are trying to use fixed for variable rate swaps on A-rated floating rate notes. exchanging LIBOR for 8.5. That means they are trying to do a swap for this A-rated item. For this one, they are trying to swap, right? They have applied swap. What is the swap? They will exchange, they wanted, now they already paying variable, they wanted a fixed rate. That fixed rate was 8.5. They will pay 8.5 to the outsider, right? When you wanted to pay a fixed rate, right, you have to pay the fixed rate for the other party, right? Therefore, you have outflow of fixed rate in swap. I think you know that. There is an outflow of 8.5 you have to pay to the outsider counterparty, right? Again, you are getting a rate from him also, right? The rate you getting from him is LIBOR, because question mentioned fixed for variable rate swap on the A-rated floating rate notes exchanging LIBOR for 8.5. That means you pay 8.5, he will pay you LIBOR, right? Just like AWPLR. That means you have a cost. You have to pay 8.5, you receive LIBOR. If you take this again, right? If you take this A-rated loan note again, see what is the net cost you have? Net cost will be you pay 8.5, right? But as per the agreement, you have to pay LIBOR plus 1.4. But you receive LIBOR, right? You receive LIBOR. Therefore, 1.4 is the net cost on that. Therefore, your total cost will be the sum of these two. This is your total cost on A-rated bond. Is that clear? Tell me on this chat. Sinthujan, is that clear? Just type and tell me. Anuruddha is okay. Shamila Lakmali, yes. Okay, right. Not clear. Right, I will explain it. Now, I think you understood you have debtors in your balance sheet asset side. Then you are going to borrow money, right? You are going to borrow 190 million, right? By securitizing 95% of your debt, right? Out of that 190 million, 80% will be A-rated bonds. You are going to issue and collect money at this rate, but you want to swap it. You want to swap again LIBOR. You will pay 8.5% to our counterparty. He will pay LIBOR to you. Once he pay LIBOR to you, this is your original expense. This is your original expense, but you get LIBOR. Therefore, you pay LIBOR, you receive LIBOR. Net cost will be 1.4. In addition to that, you have to pay 8.5 as per the swap agreement. Therefore, for this A-rated bond, you have to pay 9.9. Is that clear now? Shamila Lakmali? Okay. Moving into the question again. Service charge of $240,000 per annum will be charged for administrating the income receivable from loan. That is this. You have a debtor receivable. On that, they charge $240,000 as administration cost from the collection. Generally, you know, if you factor your debtors, if you hand over this for the collection team, there is a cost of collection $240,000, right? That is the cost on this income. 240,000, that is 0.240. This is an expense. Therefore, your net interest income will be the net of this, right? 20.76 is the net income from this debtors, right? Debtor receivable. That is about this, right? Net will be after administration cost of your debtors to $20.76 million, right? This is how you are going to borrow money and pledge your debtors and swap. Okay. Now let's see the question. You may ignore the prepayment risk. That is okay. Calculate the expected return of the investment in each of the three tranches described above. Expected return of the investments in each of the three tranches described above. What are the each of the three tranches described above? These are the three tranches described above. Right? Carefully listen to me. These are the three tranches described above. Calculate the expected return. Now you have to think like an investor, right? You have to think like an investor and calculate the return if you invested on these bonds. That's the question. What could be the return by investing on bond as an outside investor? Is that clear? Now tell me, did you realize the question? Shamila Lakmali? Good. So, Sintuja? Now, what I want to tell you, this is the real problem you face at the exam, right? At the exam, you will read question and I will tell you clearly, right? You will read the question. While you read in the question, your mind is trying to connect this information with a pre-practice questions at the homework class. Don't do that. This is the biggest disadvantage that students have, right? While you read in the question at the exam hall, you are trying to connect your mindset with a pre-practice question. Am I correct, Upendra? Don't do this mistake, right? Read the question with fresh mindset. Try to understand what actually examiner ask. If you relook at this question again, see, calculate the expected return of the investment in each of the three tranches described above. If somebody invested on these three bonds, what will be the return? Okay. If somebody invested in first one, right? A-rated floating rate notes, he will get LIBOR plus 1.4. He will get it, right? Because of the SAPs, he will get 9.6 as we calculated on this Excel. Because of the SAPs, he will get 9.6. Okay, let's move into the answer now. Look at the answer. This is the income part. I told you I have prepared a P&L to show the income. This is the income, right? Is that clear? 10.5% on 200 million and the service cost. Therefore, your total income on the loan given to customers, right? Your total income will be, this is income, right? This is the inflow you have to the business. Now let's calculate the company's point of view, finance cost, investors' point of view, the return. 80% collateral value, LIBOR plus 1.4%. Right? This is subject to swap arrangement. You know that. You pay LIBOR, sorry, you pay 8.5, you want a fixed rate, that counterparty will give you LIBOR. Therefore, your final cost will be this 1.4 and 8.5 as we discussed in the Excel sheet. Therefore, your total cost on A-rated, this is A-rated, right? A-rated bonds, 1.4 on 80% of collateralized loan percentage into 200. Again, 8.5. They have calculated it together. Separately here, this is the total value. Let's calculate in our Excel sheet. Here, 200 million is the debtor value. Out of that, 95% you are going to collateralize and borrow money. Out of that, 8%, 80% is the loan. Right? On that, you have to pay 8.5. That is 12.92. This is the amount. Right? Again, you have to pay, since you get in the LIBOR, only 1.4. Let's apply that also. 1.4. You have to pay additionally 1.4 because of that is 2.13. Right? Totally 2.13 and 12.92. These are the two numbers. Is that clear, Buddha? Upendra? Upendra, just tell me whether it's clear or not. Right. Now, if somebody invested on these A-rated bonds, right? A-rated bonds, he will be ended with these two. That's all. His return. Okay. Now, B-rated bond. If you invest in this B-rated bond, it will be 10. It is the 10% of the collateralized value. Pay 11%. Very simple. Look here, right? On B-rated, the amount is 19 million, 11%. Right? If you take 11% is the rate, amount is 19 million. 19 million into 11%. Right? That is 2.09. Going back to the answer, we can check. That is 2.09. This is the return on B-rated if somebody invested. From the company's perspective, that is the cost. Investor's perspective, that is the return. Many times I told my students when I am lecturing, cost of, we call KD, cost of debt. We call KE, cost of equity, right? This is the cost of the business. From the investor's point of view, required rate of return or yield to maturity. Company will pay, investor will receive, right? Company call cost of equity, investor call, shareholder call, required rate of return on shares. For bonds, company pay cost of debt, KD, investor will receive it. That's called yield to maturity. If somebody asks you to calculate yield to maturity, that is cost of debt he asks you to calculate. If somebody asks you to calculate cost of debt, that is the yield to maturity people ask you to calculate. There are two parties in a financial instrument, keep in your mind, right? Shares or bond or whatever loan notes. There are two parties. That's why it's called a financial instrument. Then two parties defined in the two different way, but calculation will be same. Right. Now, without that unrated, total you pay 17.14. Right, Upendra? Without this unrated, we only discuss A-rated and here we only discuss A-rated cost and B-rated cost. This A-rated and B-rated totally paid 17.14, but your total, this is your finance cost, right? This is your finance cost. This is your outflow. For A and B. For A and B, you pay 17.14. For total, you receive 20.76. Therefore, balance you can use to pay for unrated subordinate certificates, right? This balance 3.62, that is income and outflow expense difference, is the saving out of the total interest income. Once you paid 17 for A and B, balance 3.62 you can use to pay for the subordinated certificate unrated. I think you can remember now. Subordinated certificate unrated, right? To pay for the third type of bond, you have balance of 3.62. Therefore, the value of the unrated subordinated also 19 million. I think you can remember in the Excel we have calculated, right? You have 3.62 to repay for them. Therefore, your return is 19.05. Without the sensitivity, this is the return. Now tell me whether it's clear. Upendra, Lakmali, is that clear? Okay. Now in this question, there is another sub question, that is they ask you to do the sensitivity, right? Estimate the sensitivity of the subordinated certificate. That means the third one, right? Which you gives 19% return. Here they ask you the sensitivity of subordinate certificates. Sensitivity of subordinate certificates. The reduction of 1% in the return. 1% in the return. What will happen to the 19% return they are getting? You estimated they will get 19.05% return. What will happen to this if the return decrease by 1%? If this return 20.76, right, decrease by 1%, right? If this decrease by 1%, this one decrease by 1%, what will happen to this 19.05? Right? Look at the answer. 1% of total income, this is the total income you calculated above. 1% on this is 0.21, right? If return reduced by 0.21, it definitely reduced by from this return. From this, it will reduce. Why? Both A and B rated number 1 and 2. That means this and this, right? These two get fixed return. Why? This also sap at a fix. This already is fixed. Therefore, they are getting a fixed return. Only variable return received by third category. Any reduction of the revenue of the company will affect only these third class bonds. Therefore, the 1% reduction is 0.21 out of the total revenue, right? 1% on these. This affects, this would reduce cash available for unrated subordinate certificates, right? Generally, it's available 3.62. Now it's reduced by 0.21 and it is ended at 3.41. Then 3.41 as a percentage is 17.95. 1% reduction of revenue of the company will reduce that unrated subordinate certificates return from 19% to 17%. As a percentage, it is 5.8%. Right? Now tell me, did you get the full understanding? Sir, 3.62 interest cost is represent 10% of the subordinate certificate. Yes, because A is a variable rate, A rated is a variable rate bond, but you swap with a fixed rate. Therefore, it has a fixed interest rate. B already a fixed rate bond, also at a fixed rate. But third category is subordinated certificate unrated. That means you have not confirmed the return. Whatever the remaining income, you can pay the return. If return comes down, third category gets low return. If return going up, third category gets more return. That's why they ask the sensitivity question as well. Is that clear? That unrated means you are not confirmed what is the interest you are going to give them. You will pay interest once you pay for other rated bonds. Can you explain about the unrated one? What you want to explain? Just tell me, Buddha. Can you explain about the unrated one? What? On unrated, what you want to understand? Just type and tell me. I can't see your names. That's why I can't talk to you. Right? If I explain the overall picture of this question, you have an asset. For the sensitivity don't we need to call 10.5 to 1% for income. Incoming decreased by 1%, Pudha, not the rate. Don't misunderstand. 10.5 is the interest rate you can earn. 10.5% on 200 million asset gives you 20 million point some amount of income. Now, income reduced by 1%, not the rate reduced by 1%. Don't misunderstand that. Madhusha, is that correct? I think you realize that is 1% reduction of rate, not the 1% reduction of rate, 1% reduction of income. Income and income rate is two different, right? Madhusha, is that clear? Okay. Now, GKUC, you asked me to, can you explain about the unrated one? What you wanted to understand? We have 200 million receivable balance, gives us 20 million plus some return to us, right, at 10.5% rate. By pledging that, we issued three types of bonds. Number one, A-rated bonds. It's a variable rate, but we swap it at a fixed rate. That's number one. Then number two, B-rated. It's at a fixed rate. Therefore, both A and B investors gets only fixed income. Whatever the remaining return, you can allocate it for the third category of bonds. Because third category of bonds are subordinate certificates, unrated. You have not secured. You have not promised them, we will give you a fixed return. You have not guaranteed. Therefore, these people getting higher risk. They are almost like shareholders. If you have more return, they get more return. If you have less return, they get less return. Is that clear? GKUC, that's the name you mentioned. Okay, good. Now that is the end of this question, right? Now again, I have included this question because you people not think practically how to manage the finance. You just only go through the lecture videos, tunes, or physical classes and trying to get through the subject and become a chartered accountant. Finally, we will be in a trouble when you're trying to recruit a chartered accountant for our companies. It's a big issue I'm facing every year when we are interviewing people. They don't know how to answer technical questions. They just pass the exams and got the certificate. That's why I want to tell you, give more focus on these rational points rather than doing just calculations, right? Okay, that is the end of question number 1. Then we are moving into question number 2. Therefore, if you are not strong enough in these areas, my advice, be prepared with these areas before the exam. Only 1 week you have. Right, this is working capital question. Let's read the question first. As I told you, calculate the working capital deployment and relevant financing cost. Find the maximum credit exposure and determine the financial impact of audit committee recommendation. Okay, now let's read the question. Flavor Green FG is a tea exporting company in Sri Lanka. Its annual revenue approximately $20 million, right? $20 million. Their net profit margin and gross profit margin 10% and 2% respectively. This question about working capital, therefore gross profit margin is very important, that is 10%, right? If gross profit margin is 10%, right, cost of sale is 90%, right? Therefore cost of sale of this item, right, 20 million into 90%, because 10% is the gross profit margin. Therefore cost of sale we can assume 18 million, right? 18 million. This company is in tea export, right? That's very important. Tea export company. Sales 20 million, gross margin 10, then cost of sale would be 18, right? Okay. The audit committee of the company is concerned now it is increasing working capital requirement where inventory is around 2 months, inventory collection, inventory turnover period 2 months, data collection period 3 months, right? Since tea is purchased in auction, this is very important. Since tea is purchased in auction, why this is important? Generally, you don't have huge inventory. You bought at auction and exported, right? You buying it at auction and export. You are not trying to maintain huge inventory levels, right? Therefore, your cost of sale always equal to the inventory. That is the assumption you have to make, because you are not a manufacturing company. You are not stocks making stocks, right? You are in the buying and selling. Therefore, you should have an inventory equal to the next sale, next year sale. That's also maximum. Therefore, you can assume your inventory also equal to this cost of sale. They are purchasing it from the auction. They have to settle their debtors within 2 weeks. That is half of month. This is the creditor settlement period. Half a month. 2 weeks, right? They have to settle within 2 weeks, means a half a month. The audit committee has recommended that chief financial officer should review the credit exposure of the company and obtain an export credit insurance cover. Perusal of the debtors recorded revealed that beyond borders from Syria own 80% of the total debtors outstanding. One of the big customer has 80% of the total debts. 70% of this outstanding amount is via confirmed letter of credit. If there is a letter of credit for the sales you made, don't worry, bank will settle on behalf of the customer. Therefore, there is a security on that. The remainder is document against acceptance. That is the risk. The 30%, document against the acceptance. Once the good reach there, they will give you the money. That's the risk. Once the customer takes your goods, he will ignore the payment. The Sri Lankan Export Credit Insurance charge $0.45 premium for each $100 value, right, for the insurance cover. For the balance debtors, FG will obtain bank guarantees. If you have a letter of credit or bank guarantee, don't worry, there's a security for the collection. But document against acceptance means there is a risk. Therefore, this is the area you want to have a insurance cover. We are talking about the debtor insurance. 70% of debtors via letter of credit. That means you have a security, right? Out of this 80 million debtor, 80% debtor. Then 70% based on document against acceptance. That is the risky area. Therefore, this document against acceptance, you need to make a insurance cover. Your cost is 45 cents, right? Calculate the working capital deployment, right? Let's move the answer. I think you can remember your sales was 20 million, right? 3 months is the collection period. Therefore, your debtor balance will be 5 million, right? I think you can understand. Inventory, I told you, they generally makes the inventory for next order. Therefore, you can take cost of sale as the inventory. 10% is gross margin, therefore 90% is the cost. Inventory turnover period is 2 months, therefore your inventory balance will be 3 million. Again, your creditors, that is the cost of sale. We assume inventory and creditors are equal. Therefore, 20 million into 90% because 10% is the margin. This is the creditor. Half a month is the settlement period since you purchase from the auction. Therefore, this is your creditor day, right? Therefore, your total working capital requirement is 7.25, right? Your total working capital requirement is $7.25 million. Here, question mentioned for short-term loan, banks charge 4% per annum. Therefore, finance cost is $290,000, 4% on working capital balance, right? Then they ask, what is the maximum credit exposure? Out of this total debtors, this is the debtor balance, right? 80% is a single customer. Therefore, 5 million into 80%, you can see here, 5 million into 80%, right? Single customer. 70% he gave us letter of credit, no risk. Other customers also gave us bank guarantees, no risk. Then 70% of this special customer, letter of credit, balance 30% at acceptance. That is the risk area. Therefore, your credit exposure is equal to debtor balance into special customer 80% into unsecured 30%. That is 1.2 is the credit exposure you have. If you take an insurance cover, your cost will be $5,400 because insurance cost is this percentage, right? Now you have to make a recommendation. Your recommendation, yes, because your credit exposure is this much, to secure that collection, you have to pay $5,400. To secure $1.2 million, it is worth to pay $5,400, very small amount, as an insurance cover. That is the answer for this question, right? Now you can ask any question if you have. Please tell me. Unrated bond are eligible for all remaining the net income. Once you secure, right? Once you secure your bonds again a specific income, they get it. When it unsecured, once you agree, I will give return from by this earning, you have to give them the total earning, right? But it is unsecured means when the return going up, you get more. When the return coming down, you get slow. Okay, tell me whether you understood this working capital question. GKUC. Madhusha does. Please tell me whether you got the point of working capital question. Why nobody? Yes. Malik say yes. Yeah, right. Thank you. Now let's move into the second part of this question. This is the crucial part I know for you, because if you take interest rate risk management part, over the last 10-15 years, examiner tested mostly in interest rate swaps. But in our syllabus, we have big two areas called interest rate futures and interest rate options. Examiner not completely tested these two over last 15 years. I will take the responsibility of this statement as well. They have not tested properly. especially this syllabus as well as last syllabus. If you take from 2015 to now, no question tested properly for futures and options. Nobody asked why it is not testing, but I know if we ask it from the examining examiner will tell us this is not practicing in Sri Lanka. But since you are trying to become a chartered accountant and going to abroad, you are trying to work globally, you must know. Therefore, examiner may think this time he want to test these two. That is interest rate futures or option. That's why I included these two questions this time. Right? Again, there is a possibility of testing SAPs this time. But I wanted to tell you, I wanted to give you the knowledge of option and futures as well. If examiner asks, you can easily answer. Right. Now let's read the question. Following the collapse in credit confidence in the banking sector globally, there have been high level of volatility in the financial market. Volatility in the financial market means interest rate can be increased or decreased. Both can happen. We don't know. Forbes company is UK listed company and has a borrowing requirement of 30 million. His requirement is 30 million dollars pound he want to borrow in 2 months in 1st March. That means he is 1st April today. Sorry, 1st January today. Right? I will summarize here. Now he is, let's take this as the timeline, right? This is the timeline. He is in 1st January here. He is here. Today is 1st January, right? 1st January. In 2 months, he want to borrow 30 million, right? In 2 months means this is 1st February, 1st March. Here he will borrow, right? In 1st March, he will borrow money, right? Here he will borrow money. 1st March, he will borrow, right? How much he will borrow? 30 million pounds. I think I'm correct. Yeah, 30 million pound he will borrow in 2 months. Then read in the question further. Sorry. And expect to be liable to make repayment in full amount 6 months from now. Loan will be settled in 6 months from now. Loan will be settled from 6 months from now. That means loan period only 4 months, right? Loan will be settled in 6 months from now means loan period is this. This is the loan. 6 months from now. Now is today. Therefore, loan period will be 4 months. Loan period. We call tenor, right? Tenor of the loan. Right? This is the tenor of the loan. Let's read the question further. The governor of the central bank has suggested that interest rates are now in their peak and could fall over the next quarter. Central bank governor says interest rate can be come down. However, the chairman of the Federal Reserve in the United States has suggested that monetary condition may need to be tightened, which could lead to interest rate rises throughout the major economies. But chairman of Federal Reserve says the rate can be increased in future. Now you are in indifference. One person say it's come down, another person say it can go up. If it is come down, you prefer have a floating rate. If it is going up, you prefer have a fixed rate. That will happen, right? In your judgment, there is now an equal likelihood that rate will rise or fall by much 100 basis points. That means rate can be increased by 1% or decreased by 1% in next quarter. Current LIBOR rate is 6%, right? LIBOR rate is 6%. Today LIBOR rate is 6%, right? And POBs can borrow at a fixed rate of LIBOR plus zero point 0.5 borrowing rate, right? Borrowing rate of the company. We have a company here. Their borrowing rate LIBOR plus 50 basis point means 0.5%. This is the borrowing rate of the company, right? This is the current LIBOR. Keep it in your mind. They want to keep the maximum rate as 6.6. That's their requirement. Short-term sterling index futures. Interest rate futures. Here we are coming interest rate futures. Contract size 500,000 pound. Tick size 12.5. You don't want to worry about tick size because there are two ways to use it, right? The open and settlement prices of 3 months future contract are shown below. Open means the starting price, settlement is the ending price, but these prices available today, right? Today price of the futures. Today price of the futures. Therefore, when you take today price, you must take the settlement price. Now you are in January 1st. Since you are in January 1st, if you want to do a future agreement to minimize the risk, right, you have to deal in futures market during this period because you will borrow money on 1st March, right? Today you are trying to enter into a future agreement. Got it? Today you are trying to enter into a future agreement. I will take here and explain. You are here today, right? You want to hedge the rate till 1st March. You are trying to use a futures. For futures questions, you need what is the price of a future. Before that, you need to select the suitable future. You have 3 futures: March end futures, June end futures, September end futures. Since you are going to borrow at 1st of March, better to use March futures because this will applicable till end of March. Therefore, today price, 1st January price of a future is 93.88, right? If you select a future today, future is a financial instrument. Today price 93.88. Generally, we will write is 0.9388. This is the way we use for the ease of calculation, right? 93.88, we can write down 0.9388, assuming 100% is 1, right? This future will be ended on 31st March, but definitely you will get rid of this future before the end of the future because, right, you want to sell this, you want to get rid from this future contract before 1 month of the maturity, right? Therefore, you have to find out what is the price of this date. That's the question. They have mentioned here, you may assume basis diminishes to 0 at contract maturity at a constant rate over the time, and the time intervals can be counted in months. Generally, in CA exams, in the syllabus also, ISO, at the get out point in future date, get out point, they will give you the price of the future. In the study text, they gave you. But generally, you have to calculate it. You know the relationship between futures and the interest rate. Say we are in January 1st. We want to hedge the interest rate on 31st March. Say today interest rate is 6%. If you believe 31st March interest rate will be 10%, right? The meaning of that, future price will decrease. When the interest rate going up, futures price will going down. There is a negative relationship. Otherwise, you can't hedge, right? Today, when we are standing 1st January, say interest rate is 6% and futures price is 93.88. Today's future price is the expectation of 31st March interest rate. That is the relationship, right? When the interest rate increasing, futures prices coming to decrease, right? Today futures price is the prediction of 31st March interest rate. That's why they ask us to use the diminution method of getting the price of this future on the exit date of 1st March, because you have to get out from the agreement on 1st March, right? Here you expect there can be 1% increase of LIBOR. If LIBOR increase by 1% in 1st March, it will be 7%, right? Again, you believe there can be 1% decrease. If so, 6 to 1% decrease is 5%. Therefore, there is a two possible outcomes, two possible scenarios in 1st March, that is 1% decrease or 1% increase. These two can be happen, right? These two scenarios can be happen in 1st March. Scenario 1, scenario 2 on this date, right? Now, they have given you the information for options as well, right? And ask you to evaluate what is the effective interest rate when using futures, what is the effective interest rate when using options, right? Here, what is the interest rate when using options on short-term futures, right? Now, let's start calculation of the price on 1st March, because this agreement will be ended on 31st March. But we can't wait until 31st March because we want to borrow money on 1st March. Therefore, we want to estimate the price. I will write down here, right? Price of future in 1st March, before 1 month before the end, right? 1 month before the end. You know, today LIBOR rate is 94, right? And today future price is 93.88. The meaning of that, 31st March, interest rate will be 93.88, right? Because these both lines will touch. I can't explain the entire option lesson today, right? Generally, futures price and the interest rate reach the end date and minimize their gap. To explain further, I will repeat it. You are in 1st January. Today interest rate is 6%. The futures contract price is 93.88. You know, futures will price 100 points interest rate. Clear? Now, 31st March end future, today price at 93.88 means you believe, right? In a future day, that is 31st March, interest rate will be 100 minus 93.88. Therefore, we can assume, right, March ended, right, that is coming March ended value will be 0.9388. Today, that is first January, today, right? January ended. Today ended future. That means 3 months ago it sold, right? Today ended. Future should be 94. Why? Today rate is 6%, right? 93.88, sorry. Here. Is that clear? Don't worry, this price will be given, right? Therefore, don't worry much about this. I believe this price will be given in the exam, right? Today, LIBOR is 6% means today ended. Today expired today, issued 3 months ago, future price would be 94. That's why rate is 6%. 31st March ended, price will be this much. Therefore, what is the variation of price? That is the difference of these two. For 3 months. How much? For 3 months, right? For 1 month. How much? Divide by 3. Right. Now, let's see how to solve this question. Now, we know in future question, first of all, we have to calculate the gain or loss in the futures market. When you entering into a future agreement, as a borrower, you know, you need to sell the futures today and buy futures agreement in 2 months time. That is 1st March, right? Therefore, you have to write down what is the selling price of futures. Sell, right? We are calculating futures outcome, right? Let's take here futures outcome. Gain no loss. Sell at today price. How much the today price is this, right? Buy at 1st March price. Per month, the change is this much, right? Now here we assume in this column, look here carefully, in this column, we assume, right, interest rate will increase. Got it? Interest rate will increase from 6 to 7%. If interest rate increase in future, definitely futures price should be decreased, right? Definitely futures price should be decreased. If the interest rate is 7% in a future day, right? We have two options, 7% or 5%. The 93 will be the futures price. If the interest rate is 7%, futures price should be 93 at the end of the March. But we want before the March. Therefore, 1 month. Before end of March, we want 1st March. Therefore, 1 month variation we have to remove. When interest rate continuously increasing, futures price continuously decreasing from today price. End of March, it would be 93. Therefore, it should be before 1 month, right? What you need to do, 0.933, you have to remove this value from it to remove 1 month. Therefore, 1st March, buying price will be 92.96. But I want to tell you, don't worry about this pricing part because you are study test, not given the pricing part. No, not given an example for pricing. But you have a separate topic saying how to price the futures. That's why I included this question. There is a topic called how to price the futures, right? Therefore, this type of question can be included asking you to price it, right? You sell it at 9388, you buy it at 9296. Therefore, definitely you have a gain because you are selling at a higher price. Your gain will be this minus this, right? This is your gain per 1 unit. Now you need to calculate total number of contracts, right? You need to calculate total number of contracts to calculate the total gain. But before moving into that, let's take this scenario also to complete, right? Here you have a gain. Let's put bracket, then you can easily understand, right? Here you have a gain. I will take decimal points. Now here again, our price is same, this one. Now we need to calculate the price first 31st March. We assume 31st March, we assume interest rate will be 5. If the rate is 5, your futures would be 95, right? But 31st March, before 1 month before 1st March, you need to remove 1 month impact. Therefore, you will take 95, right, minus 1 month impact. It will be 9496, right? This will be a minus number because buying price, right? Then you can calculate gain or loss. This will be a loss, right? I will correct it. Wait a minute. This plus this here, this plus this. This is how the gain no losses create. Only thing what I experience in your study test, examiner has given price at the exercise date or the exact date. But you have a topic called pricing futures. Therefore, this can be tested. With this second option, that is the second alternative, that is rate decreased by 5%. This is the loss on futures. Rate increased by 5%. This is the profit of futures. Now you need to calculate the total profit. To calculate the total of profits, you need number of contracts, right? You need the number of contracts. Therefore, let's calculate number of contracts. You know what is the formula to calculate the number of contracts, right? Credit exposure 30 million divided by contract size 500,000, right? 0.5. Then multiplied by loan period divided by contract period. You take loans for 4 months. Contract period, even though you are going to settle this by in 2 months, you have to take a 3 months contract. Therefore, contract period will be 3 months. Therefore, your total number of contract will be 80. I think these things you already learned, right? Number of contracts 80. Now you can contract size 500,000, right? Now you can calculate gain no loss, total gain no loss. What is the gain? Multiplied by number of contracts, multiplied by contract size, multiplied by, keep in your mind, you have entered into a future contract. Future contract has a period of 3 months, but rate always given for 12 months. Therefore, you have to take into 12 months out of 3 months out of 12. Therefore, when you calculate gain dollars, always you taken contract period divided by 12. The reason is always rates defined per annum basis. But you need to calculate the gain or loss for a 3 months period because your futures contract lifetime is 3 months. Therefore, your gain is 92,000 in first scenario. If you take it to in the second scenario, you have a loss of 108,000, right? This is how you have to calculate gain or loss of futures, right? This is the gain or loss of futures. Then I will take the finance cost. Now you can calculate your finance cost at the market based on the loan, right? I will use a formula here. Loan value 30 million. Interest rate at the market 7% LIBOR. Therefore, rate will be LIBOR plus 0.5. Therefore, 7.5%, right? For a period of 4 months out of 12. Loan period is 4 months out of 12. Because rate's always given for a annum basis, right? Therefore, your finance cost 750,000. When it's come to here, right? Your rate will be 5%. Therefore, your rate, LIBOR will be 5%. Your rate will be 5.5%. Your finance cost 550,000. Right? Then total cost will be finance cost plus gain or loss of futures market. This is futures market impact. It's a gain. Therefore, this should be considered as a minus. This is a cost. Sorry. Right? This is finance cost. This is a gain. Therefore, you have to take finance cost minus gain. This is your real finance cost. Right? When it's come to here, this is a loss. This is also a cost. Therefore, you have to take the total of this. In Excel, I will take total like this. Then in both cases, you can see finally you neutralize your impact. Your cost become 658,000 finance cost. Effective interest rate, very simple. You know, this finance cost has been calculated for a 30 billion loan for a 3 months period, right? For a 3 months period, you paid 650,000. You need to analyze this. Therefore, you will multiply it by this 12 and divide by 4. Then it's automatically analyzed. Your rate will be 6.58. Same thing you can apply here. Rate will be 6.58. This is the effective interest rate. This is how you have to solve the option. Only additional part you learn here, how to price the future in a future date for the calculation purpose. Generally, in the example given in the study text, you have a separate topic called pricing the futures. That's why I have selected this question. Let's see what are the questions now. May have a lot of questions now, right? So why tap on this? Let's remove this. Then let's take chat. So why maximum credit exposure given only for single customer? Why we can't give for total 500? No, because credit exposure rise how they secure give the mortgage. Now that 80% worth customer given us letter of credit for 70% of loan. There is no risk. For the balance 30%, he will pay at the acceptance. That is the place where you have risk in the imports business. Sorry, export business. Other debtors also given bank guarantees. Therefore, there is no risk on that also. Therefore, you have to only take that 30% of the 80% worth customers debt. Okay. Now here, Ashini, Tell me whether understood Madhusha, Achini, then GKUC about this future example. How you feel? Is it clear? Or what about the understanding? Please tell me the understanding before moving to the option question. I think there was a student called Sintujan. Please tell me whether you understood or not. Malit, Madhusha, Sintujan say yes. Others in the classroom? Madhusha say yes. I have 87 people in the classroom. Tilina, Upendra. Okay, now let's move into the option part, right? So actually this time is not enough. Here you have the answer. Don't worry, I will share this answer script by tomorrow by CA, right? You have the answer script here. This is the answer for uh, what we discuss now, futures thing, right? Now we are moving into option question, right? Also there, I will share. Don't worry, right? Okay, let's move into the option part now. Again, option contract size 500,000, right? You borrowing money, you want to borrow on 1st March, therefore you have to select March contract, right? You are a borrower. Since you are the borrower, you will select put options, right? In borrowing, you will select put option. You want to borrow on March 1st, therefore you will select March contract. Today rate is LIBOR is 6%. You want to hedge it, therefore you will select 6% as the strike rate. When the strike rate 6%, future price will be 94, right? Therefore, you will take this one as the cost of this option. You have to calculate the premium. You know that, right? You have to calculate the premium of the option. That is 0.168%, right? The premium is given. To calculate the premium, you need to calculate number of contracts, all the things. Okay, let's do one by one. I will take the Excel sheet again. Okay, we have two scenarios to consider under options. Market rate this is market rate, can be 7% or 8%. You have strike rate, that is agreed rate in the option, that is 6%, right? Once you take like this, you will decide whether you go ahead with or not this option. That is called action, right? Here, agreed rate is better than the market rate. Therefore, you go with agreed rate. That is yes. Your action will be yes. You will go with others, then you can easily understand. Here, strike rate is better as a borrower. Therefore, you will select agreed rate. Here, market rate is better. Therefore, your decision will be no, I am going to cancel the agreement. Your answer is no, right? Your answer is yes. Now the, you know, this is the interest rate, but we want to calculate the impact of options agreement. That is the premium of option agreement. To calculate the premium of option agreement, what we can do, this interest rate price, based on the interest rate price, we can decide what is the price of futures, right? As per the agreement, right? As per agreement, that is option agreement, future price in this case is 1 minus 6%, then 94%, right? 1 minus 6%. You can rewrite this, right? Like this, 0.9400, right? You can write now like this, the agreed rate. Here also agreed rate won't change, same. Since rate is 6%, option price would be this one. Then you can take market rate, right? The market rate we told, it will be 7% or 5%. If it is 7%, price would be 93, but you have to take 1 month before. Therefore, at the market, 1 month before price we already calculated, that is this one, right? Here also 1 month rate we calculated already for options. Now somebody can ask a question from me, why sir we take futures price? I have told in my classes as well, and I am lecturing, future is a contract. You must definitely implement and execute it. Whether market rate is better than the agreed or adverse than the agreed. Therefore, some investors, some people, business people wants an option to decide whether I execute or not when the market rate change favorably. Therefore, for the future agreement, people include a clause, you can decide whether you execute or not at the end of the period. That's why it's called options on futures, right? The real word is option of futures. That's why this question also says, you can see here, right? Using the option on short-term futures, using the options on short-term sterling futures. Generally, this is the question should be practiced. Option you can isolately learn from futures. Option given on futures, right? Therefore, future price will be this. We already calculated. Now here you can see gain no loss, right? Again, you can see a gain no loss. Got it? You know, here you decided to go with the agreement. Look here, you decided to go with the agreement. You decided to go with the strike rate. Look here carefully, right? Therefore, you can earn a gain from the agreement. If you are going to continue, execute the agreement, definitely you will get a gain because today price is the selling price. The price estimated for future is the buying price. Therefore, here you have a gain, right? Difference between this. But when it's come to the second scenario here, you decided to cancel the agreement. Look here. You decided to cancel the agreement. If you cancel the agreement, you can't earn any gain on options, right? Therefore, you don't want to calculate the gain here, right? Now you can calculate total gain. Before calculate total gain, number of contract, you can calculate all information same, number of contract we calculated as 80, right? You calculate size as well, that is 500,000. Now we can calculate gain or loss. You have a gain here, right? Gain equal this into number of contracts into contract size into rate given for 12 months. Therefore, you have to take 3 out of 12. Therefore, 104,000 is the gain. Here, no gain because you cancel the agreement. Very simple, right? Here, you cancel the agreement. You don't want to consider these things, right? Nothing to calculate here. Now, this is the gain at the implementation. Since there is a cancellation, no gain, no loss, right? Now you need to calculate the premium, right? Premium, you know how to calculate. We already identified the cost. It is from the table. Look here, from the table given, I have shown you this is the cost. When it's come to this is cents, therefore you have to take 0.00168 for the calculation, right? Therefore I will take 0.00168 as the cost into number of contract into, let's type it, into number of contract into contract size, right, into the period. You want to take it only for 3 months, therefore you will take like this. Therefore you have right. Since you calculated on this, the gain on the option, you will take interest rate at market rate, right? You will calculate the interest rate at market rate. Keep in your mind, you will take at market rate. That is 700,000. But you know, this is the LIBOR. To the market rate, you need to add 5% because 0.5% LIBOR plus 50 basis point. Therefore, you will take rate as 7.5% and interest cost will be this much. When it's come to here, again, you will calculate 30 million into market rate 5% with your premium 5.5% for a period of 4 months, right? Loan period is 4 months. Your finance cost will be 550,000. Now you can take total impact like this. Total cost, right? Here, finance cost is a cost. Premium is a cost. Gain you can reduce from it, right? Here, finance cost and premium is a cost, right? These are the cost. Here 562, here 566. Sorry, 662 and 66. Now you can annualize this easily, right? Effective interest rate. Here you will take this divide by 30 million multiplied by, you know, this is for 4 months, therefore 12 divided by 4. Then you can easily annualize this, right? These are the rates. right? Okay, this is the option. Then we are moving into the answer, right? This answer given here, don't worry, I will share this with you, right? This is the way it's calculated. Now tell me any question if you have. Wow, what happened to its screen? I will explain it again, right? I have lost the screen, right? Entire option not seen. Just type me. There was something, right? I like explaining that this Zoom said this meeting will recording. That means I lost the connection and came back, right? Shamila, can you tell me you want to explain the option again, right? From premium, right? Here, this gain calculated. There is no gain since you are not going to execute this, right? Then premium here. Look at the premium calculation. From the table, we identified cost will be this much. Number of contracts 80, right? Here, number of contract 80, contract size this much. Always this rates given per annum basis. Therefore, you have to take it for 3 months period. That's the contract period, right? That's how you calculate the premium. Then this is the premium, right? Premium will won't change. Either you exercise or not, premium won't change. Then finance cost you will always calculate on the market rate. Market rate is 7%. You have to add another 50 basis point for your rate and for 4 months at 30 billion, 30 million. He also same market rate 5% plus 5% point 5 you have to add LIBOR plus 50 basis point. Therefore, it will be 5.5 on the loan balance for 4 months. Then your total impact will be finance cost plus premium minus gain. Here, only finance cost plus premium, no gain, no loss. You have not executed. Then you have annualized the rate for annual basis because these things paid for 4 months of loan period. That's how I have explained, right? Okay. Now tell me, uh, is that okay? May not be okay because maybe sometimes this is the first time you going through this type of option examples. You have 2 3 examples in study text, but based on the past paper practice you are not giving more focus on options and futures. But tell me, at least you got some idea about option and futures, interest rate, option and futures. Shamila Lakmali. Okay. Chalani. Anuradha. Then I have few people. I talked to Malit, GKUC, I don't know the name, Omega Rajapaksha. Just tell me whether you got it or not. Right, okay. Now, there's another question here. Outline the benefits, right? Outline the benefit and dangers of Forbes of using derivative agreement in the management of interest rate risk. Here I have mentioned those benefits and disadvantages. When the interest rate volatile, You don't know whether you have to pay more or less. Therefore, through hedging, you can neutralize the risk, right? Then again, when you hedge the interest rate, you don't know, you don't have any surprises in future. You don't have any sudden losses or gain to the PNL, right? Then for the hedging agreements, you can manage your cash flows, right? Those are the advantages. Again, you have disadvantages as well. Just you have these things in your study text, right? Just read it, right? Uh, Sometimes you have to have a lot of agreements since you have predetermined traded agreements in the market in options, right? Then options are expensive. You have to make a premium on that, right? And you have to use complex accounting treatment for accounting this, right? Uh, Unless without hedging interest rate, you only expose for interest rate risk. Then when you are going to hedge through financial instrument, your exposure increase for the financial instrument in addition to the interest rate. Those are the disadvantages. Just read it. It's available in your study text as well, right? That is the end of this. The end of question number 2. Now we have to move into question number 3. That is the pre-scene related question, right? Now time is 9:11. What I have discussed and planned, I will discuss question number 1 and 2 today and don't take more time, right, to discuss the question 3 today because we have enough time. Our paper will be at the end of this month, not next week. Therefore, we have week after this to discuss the question number 3 since some students preparing for ABR and other subjects, they have a lot of work for this weekend. Therefore, I am planning to have the discussion of question number 3 on coming Monday. Probably my coming Monday, CS Sri Lanka will email you the date and time after ABR and other papers because next week we have to discuss question number 3. I talked to CA and I requested them to let's discuss question number 3 after this week, after students sit for the ABR and other papers, right? Okay, I think that understood. Then we will discuss beginning of next week the question number 3, right? Now tell me, yeah, from CA it's confirmed. It's possible probably by Monday. Now you can ask any question, you can type any question in the chat. I can answer relating to the 2 questions we discussed today. If CS Sri Lanka host here, Mr. Aruna, could you please allow his student to talk to me now since the discussion over for today?
Yes, they can raise the hand now. They can raise the hand, then I can allow them to talk.
Okay, thank you, Aruna. Thank you very much. Student, you can talk to me and ask any question that relating to discussion we had today, right? Before I end up the session.